The closing bell rang exactly 15 minutes ago, and the final numbers are on the scoreboard. The S&P 500 closed at 7,520, which is up a microscopic 0.04%.
Right. And the NASDAQ actually slipped 0.11% today.
Yeah, and the Dow eked out a 0.07% gain to close at 50,644.
Yep.
So,
Yep.
for anyone just glancing at their portfolio Wednesday, May 27, 2026, it looks like a quiet, slightly green post-holiday lull.
Just a total choppy mess on the surface.
Exactly. But usually when you slide into the driver's seat of a high-performance sports car, you expect a specific reaction. You slam the gas pedal down, you burn a massive amount of fuel, and you rocket forward.
You'd think so, yeah.
But today's market burned a historic amount of fuel, and it was just stuck in neutral. Which is why we need to dig into the strategy briefs today, because the participation metrics tell a completely different story from that flat closing print.
It is a phenomenal way to frame the tape today, honestly. I mean, a tremendous amount of mechanical energy was expended for absolutely zero forward progress.
Right, which brings us to the first major anomaly that jumps off the pages of our sources, the sheer volume of trades. I mean, total consolidated volume hit 19.5 billion shares today into the close.
Yeah, that absolutely crushes the 30-day average of 18.7 billion.
It does. But here is where I have to push back on the standard interpretation. Normally, when you see record-high index levels paired with heavy volume confirmation, that signals a massive breakout.
Right, usually means buyers are just in absolute control.
Exactly, they're willing to pay any price. Yet, the strategy briefs we were analyzing are calling today's flat finish a distribution phase instead. Why is that?
Well, the confusion comes from only looking at one side of the trade. You have to visualize the order book to understand this concept called high conviction churn.
High conviction churn. Okay, unpack that for us.
So yes, there were a massive number of eager retail buyers stepping in, right? Throwing capital at the market. But for every single buyer, there was an institutional seller meeting them with equal unyielding force.
So the buyers were basically running full speed into a brick wall.
Exactly. And looking at the sector breakdowns, that invisible wall was built right at a very specific psychological level. The $1 trillion market cap barrier for the chip sector.
Oh, wow. So that was the exact ceiling.
Yeah, high volume paired with a flat finish at a major psychological level is classic exhaustion behavior. I mean, the smart money, the large institutions, they're using the immense liquidity provided by all these eager retail buyers to just quietly distribute their shares.
They're unloading their positions and handing the bags to retail.
Right, but doing it without triggering a panic that would crash the price.
So retail is pushing with everything they have, but the price isn't moving because someone huge is on the other side of that trade dumping shares.
Yeah.
Which, begs the question, what exactly triggered these institutional whales to hit the sell button today?
I mean, the answer lies in how they reacted to the geopolitical head fake we got this morning.
Right, the morning catalyst. Now, just to impartially report the facts directly from our sources without taking any political sides here, the market actually gapped up right out of the gate on rumors of an Iran peace deal.
It did, yeah.
But then, midday, the White House officially called this deal an absolute fabrication. And the market mechanics before and after that denial were violent.
Oh, totally violent. Energy became the clear leader there.
Yeah, gaining 1.4%. Because once the peace deal rumor was killed, the reality of Middle East supply concerns came rushing back. I mean, it kept Brent crude oil prices elevated right at that $100 mark.
And conversely, you had rate-sensitive sectors getting completely punished. Like real estate dropped 0.9% following a very sharp decline in purchase applications on the MBA mortgage index.
Right.
But the real story is how the institutions handled that morning rumor-driven gap up. Because they didn't buy into the euphoria at all. They actively faded it.
When you say they faded it, you mean they weren't just ignoring the early rally. They were actively using that artificial price bump to sell into the strength.
Exactly right. They were aggressively trimming their exposure, specifically targeting the Magnificent Seven and the semiconductor space.
But the real risk here is the underlying logic of that move. I get that taking profits makes sense, but if AI is the undisputed future of the economy, which is the core narrative driving this whole bull run, why are institutions rotating out of tech?
Well, it does sound counterintuitive.
Especially when the sources note they were moving that money into consumer discretionary names like Bath & Body Works and Abercrombie. Like, why trade the future of computing for scented candles and sweaters?
I know, it sounds crazy on the surface. But this is a textbook de-risking maneuver. And it's driven by a very specific mechanical liquidity drain,
Which is what?
the upcoming SpaceX initial public offering.
Okay, wait, I need to stop you there. How does an entirely private company's IPO suck so much oxygen out of the room that it forces public AI stocks to stall?
Think about the sheer scale of the capital required for that IPO. When a private offering of that magnitude hits the market, institutional fund managers have a mandate to capture that generational growth, right?
Right, they have to be involved.
But they cannot buy into a private IPO using unrealized gains from their public stock portfolios. They need hard, liquid cash, billions of it.
And they don't just keep that kind of money sitting idle in checking accounts.
Exactly. So to free up capital, they look at their portfolios. And they aren't going to sell their losers. They sell the assets that are up 150% year to date. They lock in those massive profits on AI and semiconductors.
Oh, I see. So they use the retail enthusiasm as an exit door, convert those tech shares to cash, and park whatever they don't immediately need for the IPO into fundamentally sound, high-quality consumer names.
Right, like Bath and Body Works. Just as a temporary safe haven, it's a mathematical rotation, not a judgment on the future of AI. They're basically just keeping their powder dry.
I mean, the problem for the retail investor is that when the big players head for the exits, they leave a massive wake. This institutional trimming wasn't an orderly, gentle rotation today.
No, not at all.
It resulted in some spectacular intraday crashes for absolute market darlings. The tape was literally littered with Icarus moments. You know, stocks that flew way too close to the sun and had their wings melted.
Yeah, we saw several high-profile open-high, close, low-key reversal markers.
Right. NVIDIA, the absolute poster child of this market, opened strong but finished down 2.37%.
Starting to look really exhausted.
Yeah, and JP Morgan dropped 3.02%, which is a major reversal as the financial sector started feeling the heat from the intense volatility in the 10-year yield. But I want to zoom in on Micron because our sources highlight it as the perfect case study for today's session.
Oh, the Micron action was wild.
It actually crossed the $1 trillion market cap intraday, hitting roughly $917 a share, and then it just pared those gains away as its gamma squeeze hit a total wall.
And it wasn't just the mega caps feeling the burn either. The earnings reactions today were just brutal.
Oh, totally washouts. Zscaler plummeted 25%. Yeah. Vera Mobility cratered an astonishing 54% on their print.
Right, and it makes you wonder, in this specific environment, is a quote-unquote good earnings quarter just a guaranteed way to lose a quarter of your market cap?
Well, that is the reality of being priced to perfection. I mean, when a stock in the AI or tech sector is trading at the massive forward multiples we're seeing, the current stock price isn't reflecting the company's current value.
No, it is pricing in a decade of uninterrupted miraculous growth. The momentum trade requires continuous miracles to hold these price levels.
So if management comes out and just delivers, solid or good numbers, the mathematical illusion breaks.
Right.
The market realizes the miracle isn't happening on schedule, and they re-rate the stock violently downward.
Exactly. The margin for error is absolutely zero right now. If the future growth was already fully priced in by yesterday's buyers, today's solid earnings report is actually a huge disappointment.
Right, so if individual stocks, even the untouchable darlings, are getting punished this harshly, the overall index's resilience near that 7,500 mark has to be a mathematical mirage.
It absolutely is.
Which leads us directly into the market internals, the breadth, and the elephant in the room driving all of this, which is the Federal Reserve. Unpacking these internal numbers from the strategy briefs, the advanced decline ratio ended at a dismal 0.9 to 1.
Meaning more stocks fell than rose.
Exactly. Only 22% of stocks are actually outperforming the S&P 500 over the last 30 days. And this next statistic is staggering. Half of the S&P's year-to-date earnings growth is coming from just 5 massive junk companies, the hyperscalers.
Yeah, the sources call this a localized flood, not a rising tide. If you aren't plugged into the AI power grid, you are basically treading water.
Or drowning. Because if you look away from those 5 companies down the market cap ladder, the Russell 2000 is down 4%.
While the S&P 500 is within 0.6% of its all-time high.
That is a massive divergence. Why are the small caps getting suffocated while the major indices just hover at record highs?
Well, it comes down to balance sheet architecture and a profound regime change at the Fed. Think about how a mega-cap tech company operates today. They are essentially sovereign states.
With fortresses of cash.
Exactly. Tens of billions of dollars sitting on their balance sheets. In a high interest rate environment, they're actually earning 5% interest on that cash pile. So the high rates are a revenue stream for them.
While the small caps, on the other hand, don't have mountains of cash. They operate on thin margins and rely on variable rate debt just to make payroll.
Right. They need that debt to fund operations.
So while Apple or Microsoft makes money on high rates, the small manufacturer in the Russell 2000 is watching their borrowing costs double, which is just crushing their margins.
And those borrowing costs are staying elevated because we have officially entered a new era at the Federal Reserve under Chair Kevin Warsh. The market has finally woken up to the reality that the Powell put is dead.
The Powell put being the market's long-held assumption that at the first sign of economic trouble, the Fed will swoop in, cut rates, and rescue asset prices.
Yeah, that safety net is completely gone. We are now pricing in a hawkish reform era.
Meaning Warsh is perfectly willing to let the economy run cool and let small businesses feel the pain just to kill sticky inflation.
Exactly. Which explains the stubbornness of the fear gauge. The VIX is currently pinned at 14.8.
And usually when the S&P is at all-time highs, implied volatility collapses, right?
Right. But the sources point out this elevated floor is the Warsh premium. When you have a Fed chair willing to induce pain, combined with $100 oil driven by Middle East friction, the tail risks are very real.
The chances of a sudden sharp drop.
Exactly. The market is incredibly top-heavy, wary of this transition, and desperately holding its breath for tomorrow morning.
Which tomorrow is what the briefs are calling the macro Super Bowl. Thursday morning, 8:30 a.m. Eastern, we have Q1 GDP, jobless claims, and the April PCE, which is the Fed's absolute favorite inflation gauge, all hitting the tape at exactly the same
It's
time.
going to be massive.
The strategy briefs suggest an asymmetric trade setup here, expecting an IV crush and implied volatility crush after the data drops, meaning option premiums will deflate rapidly once the uncertainty is removed.
But the sources are obsessing over one specific number on the S&P 500, right? 7,500 level. They treat it like a trapdoor.
Right, and I want to conceptualize this because financial jargon can get really dense. Instead of just calling it a wall, it's more like a bookie at a racetrack, right?
It's a good way to look at it.
If a bookie takes way too many bets on one specific horse to win, their own personal risk becomes massive. To balance their books, they have to go place bets on that same horse with another bookie.
Right.
So in the stock market, these options dealers sold a mountain of put options, which is downside protection, to investors at the 7,500 level. To hedge their own massive risk, the dealers have to short the underlying market.
That is a perfect analogy. The dealers must remain market neutral. So if the inflation data comes out tomorrow and the market manages to hold above that 7,500 line, those dealers' short positions are suddenly losing money.
Because the market didn't drop.
Exactly. So to balance their books, they are forced to rapidly buy back the underlying index.
And that forced mechanical buying spree is what the sources call a Vanna rally, which could easily push the index up towards 7,550 or even 7,600 simply because dealers are covering their tracks.
But the danger lies in the inverse scenario. What if the PCE inflation data comes in hot? What if Warsh's fears are validated and that 7,500 line actually breaks?
Then the bookie has the opposite problem. If 7,500 breaks, we flip into negative gamma.
Right. The trapdoor opens.
The dealers are suddenly forced to aggressively short the market even more to hedge their exploding exposure. That mechanical selling accelerates the drop, creating a cascading effect.
And looking at the charts in the briefs, there isn't much structural support until you get all the way down to the 7,420 zone.
Which is exactly why the institutional consensus in today's notes is no heroics below 7,500. The regime completely flips depending on which side of that line we land on at 8:30 a.m.
Yeah, absolutely. And aside from the broad index trapdoor, the sources did flag two specific individual setups, what they call day two plays, for you to watch tomorrow.
Right. The first is circling back to Bath & Body Works. They smashed their Q1 earnings and surged 15.2% today.
So the setup here is watching for a breakout above Wednesday's high, capitalizing on that exact institutional rotation we discussed, money shifting back into quality discretionary cash havens.
And the second day two play is Micron. It surged 19.3% on Tuesday and spent today consolidating that massive move.
Because it is a pure AI memory play, the strategy here is watching if it can hold its breakout support level from Tuesday. If it holds, you often see momentum resume on day three as the late joining institutional money finally fills their buy orders.
Exactly. It is entirely about watching how the heavy machinery of the market digests these massive moves. Let's pull all of these threads together, though.
Yeah, let's summarize it.
The bottom line of today's deep dive into the reports is this. The slightly green record highs you are seeing on the scoreboard today are a mirage. They are masking a high-conviction distribution phase where smart, institutional money is quietly selling to eager retail buyers.
Right. We have geopolitical jitters artificially capping the market.
And a massive mechanical capital flight to quality happening under the shadow of a new hawkish, Warsh-fed regime.
The surface of the water looks calm, but the currents underneath are violent and pulling in opposite directions.
So for you listening, the actionable advice from today's strategy briefs is crystal clear. Do not chase the S&P 500 at these elevated top-heavy levels. Wait for a catch-up trade in industrials before adding any broad exposure.
And most importantly, in this specific macro regime, stop losses are mandatory. They are not optional.
The sources recommend having roughly 15% of your portfolio in cash, ready to deploy for the inevitable Warsh dip as the reality of higher for longer rates sets in this summer.
Precision and patience are the only ways to survive a market transition of this magnitude.
Which brings me back to the sports car analogy we started with. We have been revving the engine in neutral, burning immense amounts of fuel, but going absolutely nowhere.
Just burning cash.
Right. But here's a final thought I want to leave you with, something to mull over as we all wait for the 8:30 a.m. data drop tomorrow.
Go for it.
If the AI infrastructure engine does finally stall under the crushing weight of these higher interest rates, and if that 7,500 gamma wall breaks and dealers start mechanically selling, will this recent flight to quality into just a tiny handful of mega-cap tech stocks suddenly look less like an impenetrable fortress and more like a crowded burning theater with only one exit?